So good morning, everyone. Welcome to our presentation of angel investing. Lou Farina is one of our business analysts, and he's going to be presenting on a topic. Just wanted to give a few housekeeping rules before we get started. If you could please use the Q&A box to put any of your questions in. We will answer those throughout the presentation, so feel free to put those in anytime you have them. Please don't use the chat, as questions tend to get lost in there, and I will be putting in some information in the chat as to how you can request counseling and our events that are upcoming events that are available. So with that, I will turn it over to Lou.
Okay, thanks, Donna. I appreciate it. Hey, good morning, everybody. I'm Lou Farina from the Maricopa SBDC, and welcome to the webinar. Thanks for joining. We've got some interesting content and topics for you today. We're going to talk about angel investing. And I've done these webinars in the past, but what we're going to talk a little bit more about, it's a little bit different, is the pandemic disruptions and how that's really created some new opportunities. So, and I will echo what Donna had mentioned regarding housekeeping. Please put your questions when you have them into the Q&A, because I'd like to answer them when you actually put them in. Donna will interrupt us, and I think it breaks up it makes it a little bit more natural for me, more like we were maybe in a live webinar or a live workshop. Anyway, so introduction. So topics for today. We're going to talk about angel investing. Anybody who's looked for investor capital has probably come across this term, this class of investors. Knowing who they are is important, how they think is important, preparing is important. And then the current environment, it's really provided some unique challenges and some unique opportunities. And so the topics, we're going to talk about startup capital, where angel investing fits in the sequence. And then we're going to do a short section on angel versus venture capital. A lot of folks get that confused and mixed up in the sequence and who does what and why. Then we're going to talk a little bit more about the angel investor profile, who they are, how they think. And then that's going to lead us into a section on their return on investment, ROIs, return on investment expectations, and why the bar is really high when they evaluate potential companies. And then finally, we're going to close with talking specifically about the impact of the pandemic. Then we'll talk about some resources also for you to pursue. So I always like to start my slide presentation and these webinars with, what do people think about angel investors? Who are they? And, I use these pictorials, and one, many folks think they hear angel investors and they really see them as angels. People are going to come into their lives, come into their business, and just everything is going to be right. And I'm just going to find myself an angel investor and everything's going to be just fine. Well, unfortunately, that's not the case. On the other side, there's a lot of folks that are kind of wary, look at them as wolf in sheep's clothing, and maybe folks that are not to be trusted. There are other folks and potential clients that see them as unicorns. And when I say unicorn, I mean like, well, we know there's angel investors out there, but we've actually never seen one. Where are they? Who are they? And then really a lot of people believe that it's just you find an angel investor and they like you, you like them, and then just money comes raining down and all of your financial problems are solved and your early funding requirement taken care of. And that's not really the case either. So again, hi, I'm Lou Farina. I'm a business analyst here. I specialize in technology commercialization. My background is I've got a varied background, but I spent a lot of years in corporate ventures for Fortune 100 companies, large transactions, new ventures, acquisitions, mergers, some turnarounds. In town here locally, I've served as a strategic advisor for companies, consultant to ASU, to Thunderbird, and I was an angel investor here in town for a while. And so I kind of know the drill. Also, I'm an official reviewer now for the National Science Foundation for SBIRs, for anybody who knows what that is, but that's a separate webinar and different topic. So before we get started on the content, I'd like to tell you a little bit about the SBDC, about our services. We're part of a national organization, which is part of a state network. We've got 10 different centers in Arizona, SBDC centers. So there's folks everywhere in the state. There's really folks everywhere in the country that are SBDC counselors. We have 17 here in Maricopa, the Maricopa Center. That's where I work. The Maricopa Center is bound by geography. We serve folks in Maricopa County, and the other centers also have geographic boundaries also. So depending on where you are, it will depend on where you're assigned a counselor. But if you are in Maricopa, we can help you. So 3 things we do counseling, and it's all no fee. We're a no fee organization, prepaid by your tax dollars, partially funded by the SBA, Small Business Association, small business. I'm sorry, excuse me. And also by the Maricopa County Community District. We've got some cooperative arrangements with the Arizona Commerce Authority and also some of the cities. So we provide this counseling, which is one-on-one. We provide training. Training is what you're doing today. It's a very broad term for information disbursement. We do all kinds of webinars pre-pandemic. We did them in person. During the pandemic, everything's switched to online. Post-pandemic, probably some kind of hybrid. And then we have other resources, and I'll talk to you all about some of the resources and the tools that kind of come along with it. So the counseling, it's one-on-one counseling. You sign up, you get a counselor. We've also got some specific technical assistance areas. So we've got counselors with specializations. We do disaster loan assistance, and that's on the top of the list. It used to be on the bottom of the list, or it wasn't even on our list at this time last year. But all the CARES Act funding, EIDL and PPP and some of those things, we've got some expertise there, a lot of expertise. We do lender readiness preparation. So if you need a loan, we've got Small Business Administration lender experts on staff here, part of our CAP team that can help you prepare for a loan. We do other things. We've got marketing folks. We've got folks that specialize in buying and selling. We've got somebody specialized in manufacturing. We got a couple of us that do technology, export international trade. And then we've got a sister organization called PTAC, which actually focus specifically on government contracting. Here's the tools. I know this is a little bit of an eye chart, but there's some major tools that we have, and these are all no-fee tools, which is really, really good for our clients. So we have Growth Wheel, which is a decision support tool that helps our clients make decisions depending on where they're focusing in their business. We've got Live Plan, which is a way to really generate very efficiently a business plan, should you not want to work off a template. Again, it's no fee through us. It's not our tool. These aren't our tools. These are external tools that we have agreements with the vendors. We've got Profit Sense. Profit Sense is a financial planning tool. One of the powerful things here, you'll see SageWorks data set. It's used in other different tools, but we're able to compare your financials with like companies and like geographies, like sizes. And then see kind of where your financials might be exceeding the medians or maybe kind of lagging. We've got a couple market research opportunities. One, IBIS World, and any of you who are in startup mode, who are doing business plans, want to approach a lender, want to approach an equity investor, you're going to have to get some third-party market research. We've got IBIS World. These are canned reports. I call canned. They're pre-written reports on different subjects. I will tell you the breadth is pretty good. They cover a lot. Their depth is really fairly good too. So it's in breadth and depth. They're good reports. On the street, they're about, $1,500 a piece. We get them for you for nothing. And we can work with you on a search and provide those to you. And we also have SBDnet.org, which does some custom market research for us or our clients. Okay, so Donna, we are going to take a poll, and we're interested in, has your company attempted to raise angel capital? And we've got 5 different options. No, but we're thinking about it. We've actually pitched to angel investors. We've submitted an application to an angel group, which is a little bit different than pitching to angel individuals. We've got commitment. We're working through the deal terms, or we've secured some angel investment. So please vote, and this will help us get an idea, help me get an idea of where you guys are in the process.
Okay, I'm going to leave this up here for about 15 more seconds. It looks like there's about half of you who have voted. So if the rest of you can jump on and give Lou an idea of who his audience is, that's really helpful. Okay, we've got about 5 more seconds. Okay. So
All right.
there you go, Lou.
Okay, so most of us, 90%, 9 out of the 10 have not pitched or have not explored the idea, which is terrific. This is a really good webinar for you. And somebody's submitted to an angel group, and that's good too, because we're going to talk about groups. Terrific. Well, let's talk about, hang on a second. Come on, Lou. All right. Okay, so let's just talk about startup capital. And I want to talk about startup capital a little more broadly, and then kind of show you where the angels fit in startup capital. So if you're gonna start your company, you really have 2 choices. You're gonna do debt, or you're gonna do equity. Debt is you're gonna take a loan. With the loan, you're gonna that loan's gonna be secured by something, and you're gonna pay interest, and you're gonna pay back the loan. If you're on the equity side, you're gonna take funds, you're gonna take investment from a source, an investor, an angel, venture capital, and you're gonna give up part ownership of your firm. So there's 2 different ways to do this. But in the sense of startup capital, the first startup capital, the early capital, that seed money, is really the trickiest and the most difficult. And the 90% of you are out there, you probably know this already. There is really stiff competition for limited sources of financing. So really tough environment. But I also have to say that, if you are a serial entrepreneur, and we don't really have any on the call today, which is to be expected, and you've had a couple successful exits, or 2 or 3 exits, mean you've made a lot of money and you've created valuation, you've put money in investors' pocket. And then with that, you've got a close network of these investors are eager to fund something with you. So your next raise is going to be a lot easier than somebody who is just starting out. Most of us aren't in this boat. Almost all of us aren't in this boat. But these stories are the ones that kind of make it out. Someone raised $10 million from a venture capital firm with an 8 slide deck pitch, and that's what people hear, but they don't understand the backstory. So anyway, it's hard. So let's just talk about debt real quickly. And the fact of the matter is that most banks won't lend to startups that don't have 2 or 3 years worth of financial statements and some owner's equity, right? So, even a bank looks at a startup as somebody who's only been in business a couple years, right? They don't look as a startup like pre-rev. It's usually not an option for most folks. There are some folks that qualify using existing assets or existing equity and other things, but this is really not for most folks. But if you were going to go for this type of financing, and you were 2 or 3 years down the road, or you had some other way to kind of secure this debt, you go for an SBA 7A loan. With a 7A loan, we do this a lot as the SBDC. We ask if you got to put a business plan together, a cost expense worksheet, what you're going to spend the money on, your financial projections for the next 3 to 5 years. You're expected to have an equity infusion, 15 to 25%. That floats a little bit up, usually on the upper side, depending on your risk. They'll ask for a personal guarantee, and they'll ask for collateralization. Collateralization means that they'll reach back into any equity or any asset that you own and attach to it as part of the loan. So we usually don't go down that path. And I'm not going to talk about debt anymore in this particular webinar, but we're going to talk about equity investment and the stages of development. And then the top is really the timeline. It's really it's time series. So you have different terms depending on who you talk to. You got ideation, pre-seed, seed, startup, early, expansion later. I mean, we can play with these terms, but it's really time. And let me show you what I'm talking about. So the first money into any business is yourself. And we always joke about what's the second money in, and the second money in is yourself. So the idea is you have to have put money in before others will put money in. So you don't have to put a ton of money in, but you have to have money in that's significant to you. And then the next stage is typically pre-seed or maybe even seed, depending on who you talk to. And this is the friends and family round. This is going to my aunt, my uncle, my mother, my grandparents, people who know and love you for investment and maybe aren't as concerned about the return. There are public sources. Arizona Innovation Challenge, for instance, is a public funding opportunity here by our state. There's crowdfunding where you can actually utilize a platform to attract a small amount of investment. There's accelerators and incubators that may provide some kind of either money and or in-kind services. And then there's some grants, and really the grants primarily for if you're a technology-based company and you're early, they're SBIRs. Again, we've got other webinars on SBIRs. And we probably have one coming up here soon. We'll talk about that. But the next stage, typically, so after you've invested and you did your friends and family round, maybe you've got an SBIR, you've been through an accelerator, so you got a little bit of money in. There's money in. Money in means risk is decreased for the next investor. That's what it typically means. So that's where the angel investors typically come in. And then there's something called strategic investors. Strategic investors are typically I wouldn't call them angel investors, right? They're investors. They may be tangential to your business somehow, and maybe not, and maybe a little more patient, or maybe want to partner with you in a different way. Angels are very specific about how they want to invest and what they want to see from the venture. Strategic investors could be a customer, could be a supplier of yours, and we've got some synergy between the businesses. But an angel investor is very specific. But here, the point I want to make is angel investors are never the first money in, right? There's money that has to come into the business, and there's other things that have to happen with the business before an angel investor will come in. Okay, after an angel investor, you've got corporate ventures. So there is an opportunity to approach large corporations, especially if you're in the technology area, for venture investment. And I used to do a lot of this in my corporate background, right? So you can go to most of the big companies and they've got a venture arm, and they're looking to invest in different technologies that align with their core competencies. Okay. And not all of them have venture groups. Most do, and so there's a door to go through for the venture group. But many of them do it out of the organization, maybe buried in the businesses themselves. They've got venture functions, and so it's a source of funding that's overlooked sometimes, but it can be depending on your technology and your market, it could be lucrative. And then typically come venture capitalists. And again, so their venture capitalists are later. Look at it. You've got self. You've got your friends and family. Your angels come in, maybe corporate, maybe not, and then venture capitalists come in. And so venture capitalists are kind of way downstream from where a lot of people are in the early stages. And there are some venture capitalists that'll do seed. When they say seed, they're still talking large amounts. But it's very difficult to get them in the seed space. They're looking for much larger deals. I'll talk to you more about what that really means. And the angels and the venture capitalists typically can work together. Angels can hand up to a venture capitalist. Venture capitalists can reach down to an angel and say, hey, you're not ready for us. Go get validated by some angels. So it kind of works both ways. Not everybody needs a venture capital infusion. Believe me, most businesses don't need venture capital. Some do, but most don't. And so going right to a venture capitalist for your sources of funding is probably not the most efficient way to spend your time. And then you got, later the big dollars. You do an IPO or private equity. When you hear private equity is usually, consolidation, buyouts of largely existing businesses. I'm talking hundreds of millions of dollars. So let's talk about angel investors versus venture capitalists. And there's some subtle distinctions here. I showed you one in time sequence, but there's others. One of the things, and here's a graph. And the takeaway here is there's more angel investors at lower deal sizes, but the total dollars equal almost all the VC dollars. So angels are putting in as much money on a given year as venture capitalists, but they do it many more deals and lower deal sizes. So let me talk to you about deal sizes. Deal sizes are on the x-axis, and the total number of investors or transactions, let's say, are on the y-axis here. So when you talk about ourselves, again, the first money in, about $5 billion in any given year. And there's lots of transactions in the millions, right? Millions of people are putting money into their own ventures. And the deal sizes range, deal size, I mean, your own investment, anywhere from, $1,000 maybe to 10 or 20 or $50,000. Could go higher depending on who you are. And then you talk about friends and family. Well, friends and family are a big source of revenue, $50 billion in friends and family. And okay, there's less transactions. There's maybe millions of transactions, 1 million or so, and their deal sizes, they get a little bit bigger. Maybe you can get up into the 100K range, maybe a little bit more, who knows? And then your grants. So maybe your SBIR grants, $3 billion a year going in, and they range anywhere depending on the grant, not necessarily SBIRs, but they range anywhere from the thousands of dollars up into the hundreds of thousands of dollars. SBIRs phase two, they top out at 750. They can go to 1 million or so. Average about 265 for a phase one. And then angels. Here's where angels kind of come in. So transactions, 10,000 or so more investments, 11, 12, 15. 20,000, and their deal sizes are anywhere from 100,000 to, I'm going to say, south of $1 million or so. And they put about $23 billion in any one given year. And then we talk about venture capital. Venture capital, again, there's less, as I said before, there's less a number of total transactions, but they're at higher values, right? And they put 27 billion in any particular year. And you can see the numbers, angel and venture capital are almost equivalent. But their deal sizes, and really, you use a baseline of about 5 million and up. If you're a venture capital firm, you're looking to put $5 million in at least, or somewhere up north, to 100 million or so. It's just not cost effective for them to put in less. And therefore they look for companies that have lower risk and are further along. And then you get into other private equity, right? I talked about there's a lot less private equity transactions, in a particular year, the big private equity firms, and they're doing hundreds of millions of dollars. And what I want to point out here is intentionally, there's this void kind of in the middle. And it's between angels and it's between venture capital. And we're going to talk more about this when we start talking about the impacts of the pandemic. But if you're raising between $1 million and $2 million or $3 million, that's your raise, that's what you think you need, you're in kind of a dead spot. You're too big for angels, you're too small for venture capital. And so the advice here is you work with somebody to help break up your capital acquisition strategy to more manageable increments that align with with maybe what angels can do. Maybe you have to do a couple rounds of angels, or maybe you go right into venture capital, depending on where you are. So again, just angels, they fund 20 more times companies in terms of actual number of companies any given year, about 75,000. Venture capital, 3750. I don't know where this, what date this is, but it holds pretty true from year to year. Just lots more angel transactions than venture capital transactions. But venture capital firms are easy to find, right? They're much easier to find. They hang a shingle. They have a website. They're fairly visible. They want to be visible. And so you can find them a lot easier. It's a lot harder to find angels. So let's look at the sectors that angels are willing to invest in. And then we're going to talk about how venture capital kind of looks at things. So here are the sectors that the angels are typically, I say typically, and non-pandemic related, traditional investments. So no surprising, enterprise software, some hardware, consumer products, a lot of life sciences, mobile software, internet, IoT, healthcare, etc. Ed tech is a big one that's kind of coming up. Clean tech. And so you'll find an angel group or an angel will not be real specific on the industries that they want to invest in. And that's because they have broad experience within their groups. And then let's talk about that in terms of VCs, right? So VCs have higher degrees of specialization, while the individual firms often concentrate on 2 to 3 sectors. So here's some example. Kleiner Perkins, they hang their shingle. What are they looking for? Their appetites for hard tech, enterprise software, and healthcare. At least it was last year. Accel Partners, another firm you may have seen. They want consumer products. They want security, marketplaces, SaaS businesses. A lot of these, the reason why is because they're very deep, and they have very deep specialties in these particular areas. So it makes it very, they're able to, to understand and manage risk. Bloomberg Capital, and Alloy Ventures, life sciences, information technology, clean tech. I saw the chat blinking. Donna, is there a question?
No, I just said there's no questions yet.
Okay. All right.
Sorry.
So the question I have is, why aren't there any questions?
Right.
Okay. Okay. So I know I'm going a little fast, but again, put your questions in if you've got them, or I can take them at the end. No issue. So let's talk about an angel investor. What is an angel investor? Who are they? How do they think a little bit? So here's a slide. It's a lot of text on this slide, but because I'm giving you a SEC definition. So typically, angels are high net worth individuals who provide private, early stage capital for startup businesses. Okay. The Securities and Exchange Commission gives a designation called accredited investor. You'll hear that term, and you'll hear Reg D of the Securities Act, 1933. So they give an exemption. You don't have to, if you're raising and you follow certain, if you deal with accredited investors and do certain other things, you don't have to register it as a security. The SEC kind of gives you this exemption. But their definition of an accredited investor, the SEC's definition, is net worth of at least $1 million, not including their primary residence, or an annual income of $200,000 for individuals, $300,000 for married couples, each in the last 2 years, blah, 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 similar earnings. But this is new in 2020. There was an amendment to Reg D, and it adds a new category, and this is kind of interesting. The definition, it permits persons, natural persons, I don't know how they define a natural person, to qualify as an accredited investor if they possess certain professional certification, designations, or credentials. Okay, so that's different. Now before, and this has been traditional, it's been on, the accredited investor has been categorized or on their net worth, their wealth, or their income. Now they've added knowledge and experience. And I don't really know how this is being implemented, but it opens up the opportunity for a lot of people to invest as an accredited investor. So what the SEC is trying to do here, right, by making it a non-registered investment, they're trying to kind of save you from yourself, essentially, right? They don't want investors to invest in these type of ventures if they're not if they can't take on the risk, right? If they don't understand the risk, or maybe they don't have the sophistication. And this is the way for them to kind of designate what level of sophistication or wealth or income that they have to have.
So Lou, we do actually have a question now
Excellent.
from Erica. She's wondering, are there any angels that specialize in real estate?
Angela, no, not that I know of. They tend to be tech focused. We're gonna, we'll talk about that a little bit more, but you don't have angels typically involved in real estate transactions. Doesn't mean you don't have high net worth individuals who invest, but they generally don't designate themselves as angels.
Okay, that was it. Thank you.
Okay, so let's talk about individuals versus groups. So we've got one attendee who's actually found a group and applied to a group, but there are also there are individuals that identify as angels, and so you can meet with those folks. You can find those folks through networking, through referrals. So they're harder to find, but if you're out in the ecosystem and you're pitching for just for visibility, they may approach you, and so you typically will have lots of conversations with individuals. And this is time consuming, it's resource consuming, it's exhausting, and you get a lot of no's, you get a lot of maybes, you got even more kicking the tires, come back to me with more information type of stuff, right? As individuals. But it's a big piece of angel investing, is going through that process, and going through it with each angel. You're going to learn more and more and more about individuals, what questions they ask. So it's very beneficial, but again, it's a grind. So on the other side, you've got groups. So angels will form themselves into groups. And I'll talk to you more about who the groups are here in the state, but they come together and they don't organize themselves as a company or a fund per se. They are a collection of individuals that, and the reason you join a group, and the reason I joined a group when I came out of the corporate sector, is I wanted to see deal flow, right? So these groups will attract deals and then filter deals and present good deals or good clients, good companies to the constituency for the constituency to evaluate. So it really takes a lot of the effort out of as an individual. So if I'm an individual angel investor, I'm on the other side and I'm looking to invest, I've got to work hard too, right? I've got to go find good potential investments, and that takes effort. So you join a group, there's some dues. The dues typically cover the the expenses of meeting rooms, of maybe some hospitality, etc. Maybe some resources. But the important thing about the groups is that they're very diverse in breadth of expertise, and that's really, really powerful. And having been part of the group, it kind of woke me up to have people with different backgrounds and different domain expertise look at different deals, and everybody looks at it a little bit differently, and it's very powerful when they come together. And the other thing to really understand is groups who are not funds don't make binary decisions, right? So the way a decision is made in a group is typically they poll after there's a presentation. They poll the constituency, and they say, all right, who would like to move forward? Who would like to invest? And if there's 100 people in that group and 10 say yes, then they facilitate the investment for those 10. And those 10 make the final decision whether they're going to invest or not. And they're individual decisions. So let's say out of the 10, 8 say, yeah, I'm in, after they go through a process of due diligence. And what happens is then the group will typically form a single LLC, multi-member LLC with those 8 investors, and that will be one negotiation set of terms with the group, with the company, and then there's only one person on your cap table, and you're not negotiating 8 different sets of terms with 8 different investors. So there's some real benefit there. I will tell you though, hard to get in front of them. When I was part of the Angel Group, I was part of the committee that screened in this big screening process. You may get 50 in a quarter, and you may get down to 3 to bring before the constituency. So, and if you do get rejected, find out why. Ask whoever's giving you the rejection why. I have found that most people who are rejected either just walk away or walk away really, really mad, which, doesn't really do anybody any good. But, about half of them will come back and ask for advice. And, a lot of times you're too early. After you've done certain things, come back. So just because you've been rejected once, if you've made some progress and you've done some things, you can reapply. And we've seen, there are companies, we've seen these guys before, but look where they are now. Okay, they may be more ripe for investment. Okay, so
Lou, sorry, speaking of investments, we did have a question in the chat.
Go ahead.
Biden's new infrastructure plan proposes big government spending on R&D. Do you foresee increases in SBIR or other government funding sources?
I do. I've heard. And having dealt with government programs over the last year, I know what I hear isn't necessarily what's going to happen, right? We've all been, we're on the front end of all this rescue funding. So I'm encouraged. I think that's going to open up more SBIR funding, especially in certain areas. I think like the DOE is going to get bigger budgets. Way SBIRs work, and not to get too much off the subject, it's generally a percentage of the overall R&D budget. So only a certain percentage would go towards SBIRs, but as that budget grows, the SBIR pool will grow. Okay.
Yep, that was it.
All right.
Thank you.
All right. But let's look back at a high net worth individual, okay? And let's really think. I want to give you a more realistic view of what this person's asset allocation might look like, right? So here, a typical, you're typically dealing with somebody. An angel investor typically is in their mid 50s, maybe a little bit later. So they've done, they're well invested, they're well diversified. So if you went to a financial planner, anybody who has gone to a financial planner, they talk about asset allocation. This would be typical of an asset allocation for, 50-something high net worth individual. We got 35% in stocks and bonds. You got domestic stocks, 40%. Foreign stocks, 35%, bonds, 20%. And then there's this category called alternatives. And maybe they throw 5% in alternatives. Alternatives are the really higher risk investments for the individual. And they include REITs. So this is where a lot of these high net worth individuals utilize these vehicles for real estate investments. You'll see precious metals typically. Private equity. Private equity means angel type investing, early stage equity, and then commodities. So these alternatives, this angel investing, this private equity is really a small percentage of their overall net worth. And I got a arrow drawn down to this box here. And let's say there's $250,000 in alternatives, and all his alternatives, his or her alternatives, are in angel investing. That would be about 5% of a $5 million portfolio. So, and the $250,000 has some meaning here. We're going to talk about what that means, but typically, when you get into angel investing, they say, you really need 10 investments of $25,000 to construct a decent portfolio for an angel investment portfolio. So that's kind of where the 250 comes in. So here's the kind of the takeaway here, right? So the 250 that they're investing in their portfolio, 25 might be in yours, um, is a small percentage of their asset allocation. So, people ask me as an angel investor, weren't you worried about losing your money? Gosh, what would happen if that company went out of business? Well, what I'm trying to tell you here is they expect, and we're going to talk and show you this mathematically, why they expect most to go out of business and they're going to lose money, because it's not a big portion of their overall assets in their allocation. Now, I will tell you though, if you get somebody calls himself an angel investor and they invest in your company and they give you $25,000 or $50,000, and then they're calling you, they're really worried about losing this money, and you get the sense that this is their last $50,000, then that's not the kind of investor you really want, right? You want somebody who understands the risk and understands uh, how these investments fit in an overall portfolio. So for those of you who want a lot of information on the demographics of angels, and this is a little dated, but it still holds up. There's a report from the Angel Capital Association. There's some trade organizations. I'll get to it during the resources, but it's a big survey of angel investments, angel investors. It gives you demographics, it gives you race, it gives you age, it gives you all kinds of. I mean, if you're into data, you'll love this report. You can get it at theamericanangel.org, and you look it for the American Angel report. And that's just something. I'm not going to go through a lot of demographics, but I'll give you a little bit of data that comes out of there that I think is interesting. So let's talk about the investment amount per angel group. When we talk about groups per round, right? So a group, when they do a round, they pool their money, right? You've got these in the previous example, I said there's 8 people investing, and they put in 10, 20, 30, $40,000 each to fill out the total investment for that group for that round, right? So here's typical. Here's the distribution. You'll see 48% of the investments from the group have a round of between $100,000 and $250,000. Only 14% are less than $100,000, and that's really unusual. You can get up into the $500,000 range, 32% or so. Greater than $500,000 is about 4%. The median, if you took the median, is for, I think this was 2019, was $202,000. So now you can kind of see the amount of money you can expect to raise per round with a particular angel group. Now let's shift a little bit and let's talk about their return on investment expectations. Okay, ROI. And anybody who's been engaged with an angel or have evaluated from an angel's perspective understands the bar is very, very high for expected return, and there's a reason for this. And we're gonna dive into this a little bit. So why are they so selective? And why are they screening at such a high level? And there's a study that's called the Wilbank study. It's an old study, but it's an example. They studied 539 angel investors of this very high risk class. And they found that most startups lose money. Most folks that they invested in lose money. And less than 10% of the startups from an investor's portfolio of maybe the 10, maybe 1, provided almost all of the upside and returns for that portfolio. Okay, so this is kind of the basic idea here. And there's some data here that I can show you from the Wilbank study, the 5-year return investments of individual angel investments, right? So 17%, and 35%, I'm sorry, got nothing back. 35% went out of business, and 17% got their money back. So that's like 50% either got your money back or just nothing. 34% got 1 to 5x, 5 to 10x, but 8%, 10 to 30x, 2%, over 30x, 4%. So the upside for their portfolio to make it worth their while, and I'll show you this with some simple math, really comes from their 10 to 30 plus X returns. 30x return or 10x return means I put in $10,000, I get $100,000 back at a 10x, or I get $300,000 back at 30x. So really, really high returns from individual investments. Okay, so let me talk to you a little bit more and tell you about the home run. I know this is not a unicorn. You'll hear the term unicorn. Unicorns are like the $1 billion companies, the giant ones. These are the home runs, the 1 in 10 investment that really drives your portfolio to make this worthwhile. So let's assume there's 10 equal investments of $25,000 each. And that's $250,000 invested, right? 10 times 25,000 is $250,000. Remember, I talked to you about the $250,000 number when I showed the asset allocation on the $5 million portfolio. Now, if I got 3.3 times my investment back in 5 years, that's an internal rate of return of 27% return year over year. Okay. So if I took the stock market, if you bought the Dow over the last 10 years, you would get a return of 13.9. You would have gotten a return of 13.9%. Over 50 years, it's lower. If I added the last year in, this is probably a little bit higher. But I'm trying to make a comparison. The rate of return, 27% versus just holding the market, which is really passive investing. 27% is quite a bit higher than 13.9%, but it's not all that much higher, in terms of the risk that you're taking. So how do I come up with this? Okay, so I got a table here, and I've got 10 companies, company 1 through company 10, and my investment is $25,000 in each company. And here, the first 5, I get 0 back. Okay, 50%, I got nothing. They go out of business. Kind of expected. A couple of them, 6 or 7, 2 of them, number 6 or 7 here, I got my money back. So I put 25 in. 5 years later, I get 25 back. There's a couple that did better. 8 and 9 here. They're 3x. They gave me 3x back. And so at 25,000, that's 75,000 each. But here's my home run, number 10, right? I'm getting 25x back. So I put 25 in, and I get $625,000 back. So on my total investment of this portfolio in 5 years, I put 250 in, I got 825 back. That's where I get my 3.3x. That's where this 3.3x comes from, and this 27% rate of return comes from over the 5 years. So I will qualify this by saying when angels screen for investment into companies, everybody's looking at a company that they think can hit the 10 to 30x return. That's the screening criteria, knowing that not all of them are going to do it. That maybe if you're good, 1 in 10 can do it. Okay, so that to me, this is the point is I want to give you an example of really why these angels screen at such a high level. Now let's talk about just the math between of this 25x home run. What does a 25x home run look like really in terms of money? So you'll hear a term pre-money valuation. That's the valuation I walk in with, or I agree that with the angels that my company is worth before they invest, right? We go through the process. We love you. We want to invest. We negotiate a little bit. Okay, you guys are worth $1.5 million today. Okay, everybody's happy. We're going to put 500,000 in as an angel. That's 25% of the company, right? Because post-money valuation is $2 million. So if I took a company, it's worth $1.5 million, and today I put $500,000 in, that company now is worth $2 million on paper. And 500,000 out of 2 million is 25%. So I got 25% of the company. Let's just really be simple. This is, we're trying to be simple here. No further investment, no or dilution. Cap table doesn't change. And so the selling price, the exit in the 5 years is $50 million. Okay, this is a nice home run. So that is of the $2 million, the valuation out of the 50, 50 returned. The firm, that's where the 25x comes from, right? So it was worth 2. We build this company. We were successful. We have an exit event. I'll talk to you about exit events that net out $50 million for the investors, and I got a 25x return for the individual. If I put 25% of the $50 million exit selling price is $12.5 million. So the individuals, the investors who invested 500K in, they're getting $12.5 million back, and that's where their 25x return comes from. Donna, is there any questions?
There is one in the chat.
Okay.
How is the angel getting the money back? Is the company raising VC money and using that to pay back the angels?
Typically, as an angel, I don't like when I get kicked out by the VCs. Typically, my exit strategy is an acquisition of some point in the process. And I'm going to talk to you more about exits. So that's your exit. Your exit's typically an acquisition, some liquidity event. When you get to a VC liquidity event, that could be a liquidity event. Angels don't tip, and if they want the angels off the cap table at that point, they typically don't do as well. But all the deals kind of are a little bit different. If you get private equity coming in at some point, that could be a liquidity event way downstream, and that could be significant returns. So let's just talk about valuation, and this is just to kind of level set us. And this was in 19, and this is always a sticky point because typically the first thing that's talked about is, okay, what's your valuation? Well, that's not necessarily how you want to start an angel conversation. You kind of, asking somebody what they're valued before understanding who they are and what they are is kind of backwards, right? But valuations are important. You have to get to a valuation. If you come in with a predetermined valuation that you believe that you're worth something, it usually doesn't hold, and it can be a deal breaker for the angels because they're going to want to negotiate to a more consistent valuation for that market for similar companies. Valuations are like real estate in a way. The company in Omaha, Nebraska, same company in Bay Area, California is going to have different valuations. There's different dynamics. There's different amount of money chasing the different deals, and so it's just like a house. A house in Des Moines is different than a house in New York or San Jose. But just some very national averages. In 2019, this is before the pandemic. Things were getting pretty good. There was a lot of money being generated. There was a lot of money sitting on the sidelines looking for investment and drove valuations up. And so this was on the kind of the increase. And so, but what you'll see is between $2.5 and $4.5 million for early stage companies that angels invest in, about 46% of the companies fell into this valuation category. Under 2.5 million, 20%, 4.5 to 8 million, 26%, greater than 8 million, low percentage, 7%. Now, again, this is highly geographically dependent. I've talked to some of the angels in the South recently, and they said, we don't see anything like this. We're down here in the $2.5 million and under million and a half range for valuations for their companies. Phoenix is kind of a mid-market when it comes down to angel investing. We're not a major market, but we're not a second. We're not really a third-tier market, and so we tend to be in the middle. But the median valuation, if you looked at all of this, was $4 million for a valuation in 2019. Doesn't mean your company's worth $4 million. It means that's kind of the levels that the angels were seeing and investing at. So exit. and someone asks questions about an exit. What is an exit? Okay. And a lot of entrepreneurs think the exit is the way for me to get out of the company when I exit the company. Well, that's not what an exit is. An exit is the exit strategy for the money, not the founders. Like, so how do I get, so if I'm an investor, the thing I want to know is how I'm going to get my money out. I don't want to invest as an angel. If I'm an angel, if I self-designate as an angel, I don't want a lifestyle business. I don't want profits. I want high valuation. I want a liquidity event. I want my money out. So the company brings in the money, investors get their money out during the exit. That's where the return is made. When you're putting your business plans together, or you're putting your pitch decks together and you're pitching for money, you cannot, I will emphasize this enough, cannot ignore your exit strategy. You have to have thought about your exit strategy. Who are the likely acquirers and why? And in the medical device industry, this is really kind of, I wouldn't say easy, but typically devices are acquired by the larger companies. So you kind of know who's acquiring what, what their portfolios are. But in other industries, you're going to have to do some research. Who are the likely acquirers? And then if any information you can provide on these companies, on companies similar to yours that were exited, what they were valued at, what they were bought, and what the multiples were. So you can talk intelligently about your business, your financial projections, how that creates exit value at certain levels, whether it be profit or sales or maybe even subscriber counts. If you can have a similar say, hey, here's a couple of other companies that were in the sector recently, they exited, here were the multiples. This is what investors are going to want to see. And it's what they're going to demand at some point. They're going to have to be convinced of this before they really invest. Okay, so Donna, we're coming up on time here. I know, what did we have this till 10:30 or are we going to 10?
10:30.
Okay, good. So I've got to talk about the pandemic. More specifically, I'm going to talk about some resources, and then I'm going to talk about, I'm going to take questions. I'll take more questions. Stay on the line. So let's talk about the pandemic, okay, and the impact of the pandemic. Some very interesting things have gone on, but they've changed. So the one thing to walk away with is the ecosystem remains strong. Early stage investors are resilient. Again, look at the portfolios, a typical portfolio, look at the money put in, right? They're not folks that are worried about short-term gains and losing money in the short term. Most of the groups did not view the pandemic as a threat, and they learned how to move forward, how to adapt. And I'll talk to you a little bit more about what that means, but that created some opportunities. Initially when things hit in Q1, Q2 last year, valuations started to decrease. People took a step back, but they're now starting to stabilize. And I think I would say they're stabilized to increasing. And if you look at there's a lot of healthy signs here from a market perspective, from an equity perspective. IPO market's been very good, very strong. S&P has recovered over the last 5 months. Plus, it's been, the last 9 months or so, S&P has done a really good job of recovering. So in all, angel sentiment really has stabilized, and things are looking good. The effect on sectors, and this is for angel investment, but this is broader, right? We know that the weaker sectors were, transportation, leisure, hospitality and hotel, commercial real estate, sports and recreation, arts and entertainment, right? All these are the weaker sectors. But the pandemic has had a stronger effect, has had a strong effect on certain sectors. Anything in digital health, a lot of life sciences, mobile, robotics, AI, blockchain, ed tech, still going good. Even defense technologies. So there are certain sectors that were recognized to actually benefit or grow stronger by the pandemic, and and that's where a lot of the investing had taken place. Um, so this slide is called Spatial Diversity, and that's a fancy way of saying, I guess, we've learned to work remotely. And I'll even take it a step further. We haven't really learned to work remotely. We've learned to work in a distributed environment, and we've learned that work is not necessarily limited by physical space. Those of us who have been in this realm of working either from home or from wherever. Now, I'll tell you, I worked in the global tech sector, the Fortune 100, for many, many years. And, as soon as bandwidth became pervasive, and it wasn't always, we were a dial up, and I'm showing my age a little bit, but as soon as bandwidth became pervasive, we figured out how to work distributedly, how to take advantage of people that are in different areas and work together as teams. Um, and then at the same point, we started to ratchet down our commercial real estate. And this is like, we're talking like early 2000s. We shrunk so bandwidth, came out. We learned how to adapt. We had some of the early collaboration tools. And we, at the same time, shrunk our commercial real estate footprint. So I see that as a trend. But this is all provided. Any of us who've been doing this for a while, and I've done it before, I'm, joining the SBDC, understood the quality of life benefits that come along with that, in terms of just saving time and overall productivity. Now, that's not going to say we're going to stay in a remote environment forever or always, but I think it's going to be in the fabric of kind of the way we work going forward, and I think it's a good thing. And I've worked in it, like I said, for years, and it works. It works really well. But as you know, when you talk about startups, so what we've realized and what's happened is, startups don't need to be necessarily co-located in the same place, right? I mean, where are you based? Well, my founders are in LA. We've got some folks in New York, and this is really this kind of over the last year. This has kind of been a trend, like that the startups and the talent was really coming from different locales, and investors sitting on the other side, they see faces on the screen, and they became comfortable with the fact that even though angel investing is really a local kind of phenomena, it's maybe not necessary to always have everybody in the same place. And what that's done so it's added quality of life for the startups, for the folks that are working the startups. And one of the things that you probably remember early on, and even maybe now is still being publicized, but hit the news, is all the flow of talent out of the Silicon Valley, right? People were fleeing the Silicon Valley, and they were winding up. And you talk to angels and VC folks, they were winding up in Montana, in in Utah, in Colorado, in Arizona, in different places that they could live, reap better quality of life, but still be participate in the effectively in the startups. So what this has done is that people have moved, but also it's provided an increased access to talent. So now as a startup, I'm not just looking in my locale for people to join my startup. Now I realize, and I'm more comfortable with maybe bringing people on that are in different geographic spaces. So let's see. Okay, so capital flow. So this whole distributed environment works for investors too, for angel investors too. Angel investors are typically organized on a geographic region. It's a geographic based group, typically. People know people in the ecosystem. They know people in the different investors. They're comfortable with each other. It's a way to help, as a motivation, potentially your local economy. But a new dimension's been added, right? Now these investors over the last year have realized, well, wait a second, there are other companies that I can access. and that I can invest in. And so the flow of capital has not been constrained by geographic proximity. It's been less constrained by geographic proximity, and new opportunities have been created. And I'm not going to say that, angel investing is going to go to, a totally distributed environment where, you're just going to, find an angel wherever they are. I think there's always going to be a local presence. There's always going to be a local element. But this is an augmentation, a new dimension, and opened up opportunities for the startups, but also opens up opportunities for the angel investors themselves. Okay. So now, as a startup, now I can access capital investors. It's easier to do that aren't necessarily located in my area, and they're more willing to hear me. They're all more willing to hear my pitch. And I use this term, and I've heard it a couple different times. Now when you're pitching and you're Zoom pitching to others who are geographically not with you, or not physically with you, be brief, be bright, be gone. You just gotta be on your game, because um, so you'll increase your volume and scale by being able to go through these activities. But I know we call it Zoom fatigue or whatever. I think we've probably all experienced this over the last year, and kind of built in this mechanism where when we're on a call and it's a video call and it's not interesting, or this person isn't being succinct, or I just don't know what they're saying, you switch, and there's a switch, right? It just goes, and you can just kind of zone out. I think we all kind of experience this. Believe me, it's even more prevalent with investors. So you can get in front of them, but you got to be on your game. You can lose. If you're not on your game in the first 30 seconds, you can easily lose them, and you may not even know. Right? You're talking. They're going to give you your 15 minutes, your 20 minutes, and so make sure you pitch a second nature. I'm always a big, for those of you, we've got some early folks here who haven't really engaged angels yet. You don't necessarily have to pitch for money, pitch for feedback, pitch in contest, pitch. Don't let your investor pitches be your first pitch. Certainly don't let your Zoom investor pitches be your first pitch. Prepare, practice, crisp messaging, really important. Work with somebody who knows how to put these pitches together, and continue to iterate and evolve your pitches. So again, this is an opportunity for you, but there's also something that comes along with it. You got to be really, really prepared. Okay, so additional thoughts. And here, there's just some other random kind of thoughts on what's gone on here with angel investing over the last year. The ups and downs for angels, they typically don't really matter, right? They're taking a 5-year exit horizon, right? So not too worried in the short term. But the other thing is, VCs, we really haven't talked much about VCs here, but they've moved they've moved downstream. They were kind of impacted by the pandemic, and they were looking for later stage companies, larger investments, less risk. But then the angels, remember I showed you that gap? What happens is that gap widens. That gap between where angels invest, cut off at, $1 million, and where, VCs start at, maybe 2 million, 5 million. Well, as that gap increases, the angels are like, okay, where's the next round of funding going to come from if it's a VC backed? We definitely they need more money, be VC or not. And so what the VCs flight to these later stages to moving downstream makes angel syndication even more important. So what is angel syndication? Okay, so now I got groups. These groups are formed, and I'll talk to you more about who they are here in Arizona. But they'll quite often reach out to another group to fill out a round. This company needs $1 million. We can do, in our group A here in Phoenix, we can do, we've got commitments for 400. Let me reach out to my friends, my other angel groups in Utah. Let me talk to my friends in California. Let them know we've got something we think is good. We've got commitment of 400. do you want to syndicate? That's what syndicate means. We're pooling our money on this particular round. Can you help fill it out? So that's becoming more critical. That's happened before the pandemic, don't get me wrong, but I think what you're seeing is angel syndication become even more and more important as again the VCs move move downstream. Angels continue to play a critical role in their companies. And they provide funding, but they also provide expertise. And we didn't talk a lot about this, but yeah, they do provide. One of the reasons you want an angel is because not only cost their money, you want their expertise, you want their help, you want them as a partner investor in your company. And it becomes even more important to have these experienced folks, these angels in troubling times. And one of the ways in which they can help is, getting past cash crunches, right? So you have experienced angels or experienced business folks that are invested. As the pandemic hit and there was this cash crunch for many of us in many companies, the angel investors were able to really help the entrepreneurs in how to conserve cash, because we're all concerned about burn rate as an investor, right? What's my burn rate? How much runway do I have? That means how much cash in the bank do I have? How much investment? And how fast are you burning that cash down till I get to a point where I got to raise more cash? So you got to, cash conservation is really, really important. And angels can help with that in times of trouble. And then follow-on investments, both in VC and angels, played a larger role. So there's a couple schools of thought when it comes down to angels. A lot of angels in typical times don't want to do a second round with an existing company. That just adds too much risk to their portfolio. They would rather diversify their risk. If they're going to invest some more money, I want a new company. So not many of them like to. There are some that do, but what happened with the pandemic, as some of their portfolio companies got into trouble, they were forced. It made more sense for them to do another round with their existing companies rather than a round with a new potential investment. So we saw these second follow-on rounds be more prevalent. Okay, so any more questions? We're gonna wrap it up here. I'm gonna talk.
Nope.
Go. Nope.
No,
Okay.
there aren't any more.
Okay, so excuse me for a second. Resources. So here are your local angel groups. ATI, these are all within the boundaries of Arizona. Arizona Tech Investors, they're here in town. I was part of Tech Investors for a while. Real good group, real knowledgeable, very diverse. They've narrowed their investing kind of criteria to different sectors, but they're a very strong group here in town. There's Canyon Angels, as ATI kind of narrowed their scope down a little bit. Canyon Angels, they're out of GCU, kind of based there. They typically look at a broader set of companies in town here, so they're accessible. And these all have web pages and application processes that go along with them. So they're not hard to find, and they're not hard. Well, I wouldn't say they're not hard. The instructions for application are not hard. Putting the application in and what you've got to do is typically pretty hard, but that goes with any investor. Desert Angels, they're down in Tucson. Again, they work with the other angel groups here in town. They've got special connection with U of A Medical School and a lot of the bioscience stuff that comes out of Tucson, and they do a lot in that area. But they do a lot of different investments. Golden Seed is, you might have heard of them, fairly new here in the Valley. They started a chapter a couple of years ago by women. It's a women's angel group. So I believe all the principals are women. I think they will primarily invest in women, but I heard that they're not necessarily exclusively tied to investing in women. So I can't really say, but it really, was billed as a by women for women's group, at least initially. It's a national organization and there's a local chapter again, you can find them. Arizona Founders Fund, they're a group of software entrepreneurs who have had exits here in Arizona, and they typically invest in primarily in SaaS-based businesses, software-based businesses, and that's kind of where they narrow their scope to, at least last I checked. And then there's this new one called Arizona Disruptors. I don't even know if I call it an angel group, but it's an investment group, and it's really an individual and his wife Hamid Shoaje and his wife Loudon. Hamid was the founder of Axosoft, and he's taken $10 million of his own money and hung a shingle out, and he's got a process, and he wants to invest in local companies. And I haven't had anybody go through that process with them yet, but again, it's another source to apply. Applying is hard. But it's no, if you came to me and said, Lou, I want to go for some private investment, I'm going to tell you, hey, let's get your pitch deck together. Let's get your executive summary together. You got to have your financial forecast. I need a bit, you're going to need a business plan, and it's all going to have to be pretty tight, your documentation. And all these guys require that. I mean, nobody doesn't, and it's not much different than if you go for a bank loan, honestly, to a certain extent. So here's and again, you'll get this webinar is recorded, and it'll be on our website, so you don't have to copy the stuff down, take a screenshot. But here's the different URLs for the different angel groups here in town. You can Google them. I mean, there's no secret here. And then here's additional resources for those of you who like data. There's lots of data on angel investing. There is the Angel Capital Association. They're a trade group. They put out a pandemic impact report. I pulled a little bit of data there. You can kind of go through. They'll tell you what happened in Q1, Q2, Q3. So there's a lot of information there. Angel Resource Institute has got information. Again, I talked about the American Angel Study. There's the ACA, Angel Capital Association's Funders Report. They put this report out every year or so to talk about kind of some of the metrics. And there's an older report called the Halo Report on annual. Well, I guess it's annual on angel investment, and that's from the Angel Resource Institute. So good data. Hopefully, some of what I've talked about helps frame the data. But it really there's no substitute for talking to people who are angels or have experience, engaging with angels to get you prepared. So I've got this is a slide for questions. I've got a couple more slides on the SBDC after this. I will pause.
Yeah, there's no more questions in the Q&A or the chat.
Okay.
And we've got about 13 minutes left.
Okay, perfect. This is easy. Okay, so what do we do? Counseling. If you want counseling, if you saw something you liked here, you think you need some counseling, or would like some advising, we're business advisors, we call it counseling. You can visit our website. The typical process is we do an initial session where the counselor will meet with you, get to know who you are, kind of what you need, give you more of an introduction to the SBDC, how we work, what to expect. Then there are these iterative follow-on sessions. So we meet with our clients every month or two or so, or when needed, and on an advising basis for guidance. And then we also can set goals, business goals. We can track and report on your goals and metrics. One of the things we always track, and it has to do with the way our grant is structured, is when you the economic impact. We track your economic impact. So if you grow your business by sales, you add employees, if you inject capital, if you get a loan, that all counts as stuff that stimulates the economy. We capture it. We send it to our friends at the SBA, and that's how they know we're doing what we're doing. Upcoming webinars. We've got one on the 28th. And this is an ongoing series, digital marketing, and they're going to talk about video and image geotagging. But if you look at our, our site under events, there's all of our different programming coming up. We've got a really good digital marketing expert online here. I mean, as a counselor with a lot of business experience, a lot of digital marketing experience. And I would, if you're interested, tune in on a weekly basis. We've got another expert in restaurants, and she does a series also, and she's doing one on May 4th, how to expand your restaurant. But if you're a restaurant, this is always a really good way to provide or find some information. And May 16th, we're going to do another intellectual property webinar. It's going to be, I'm hosting it, but it's going to be by the regional U.S. Patent Office on patent basics. So one of the regional directors from San Jose is going to do this for us. On the 17th of June, I'm going to do an SBIR overview. I did one last week. It's up on the site. You can see it, but if you want to tune in for another one, join me on the 17th. And then we've got another intellectual property one, trademark basics. We've got a trademark expert from, again, the U.S. Patent Office, and he is going to present on September 9th. So see our site, follow us on Facebook, follow us on LinkedIn. There's our training events calendar, all these different webinars. There's a lot of different COVID resources, counselor biographies. Yeah, utilize our services. Thanks for joining us today. And please complete an evaluation at the end of the program. Will that be emailed, Donna, or are you going to put that up now?
It will be emailed, but I did want to mention, we just did add, first I wanted to mention to please check our events calendar, because we are constantly adding new programs. And one that we just added yesterday that is very relevant to the audience is the Venture Madness preparation webinar that Tom Fulcher is giving on May 11th.
Oh.
And you're actually assisting him, Lou?
I am.
And then if you can go back to the other slide that lists what we have. Someone is saying May 16th. The patent basics, yes, is not on May 16th. It is on, I want to say Venture Madness is May 11th. The patent basics is, we have a whole bunch. We have export on May 10th. I'm still trying to search for the, sorry, maybe it's the first week. Anyway, everything is on our calendar up to date. The patent basics. Sorry, I know I have it here. Sorry, May 6th. So there's just a 1 in front of the.
Oh, sorry about that. Well, good.
Sorry.
I better check my calendar. Yeah.
Yeah, so it's May 6th. We do have export on May 10th. We have Venture Madness on May 11th. Everything is on our calendar. We also have the Great Marketing Turnaround series that is offered, as well as the Restaurant Revitalization series. So, poor Lou probably did this slide a week ago, and since then we've added a lot of upcoming trainings. So it's all found on our website. Yes, you can also get a view our previous trainings on our website. If you go to the COVID resources page, which is right off of our landing page, there's a whole separate page that says resources and required webinars. I will be sending this one out specifically to the people that have registered, as well as posting it on our website and on our YouTube. So yeah, just make sure you follow us on social media. That's probably the most up to date, where we are creating Facebook events for all of these training activities, as well as checking our event calendar on our website.
Okay, well, thanks very much. Anything else, Donna?
No, I think that's it. The survey will be, it's an email link that will take you to an outside website called SurveyMonkey. That's just a pre-populated survey. And if you could fill that out, then we get the results back, and we can hopefully get to some topics that you guys are looking for. So thank you very much for joining us.
Thank you very much.